Hi, welcome to Crypto Coach, where we use examples to simplify even the most difficult ideas. Today we are going to talk about crypto futures, crypto options, and perpetual contracts, a beginner's guide. As digital currencies become more widely accepted as investment assets and as a medium of exchange for financial activities, they threaten to further destabilize the economy. A solid example of a product that has experienced tremendous growth and is expected to continue to do so is cryptocurrency derivatives. When it comes to cryptocurrencies, there are now a wide range of items to choose from. The fundamentals of crypto derivatives, trading options, trading advice, and the benefits and drawbacks of each are all covered in great detail in this comprehensive tutorial. So, in the crypto world, what kinds of derivatives are there? Any product or contract whose value is linked to another asset is referred to as a derivative. This is why derivatives are referred to as derivatives in traditional financial markets. A buyer and a seller enter into a contract to sell an underlying asset in the same way that traditional derivatives do. These assets are offered for sale at a defined price and at a set date. Because derivatives are based on the value of the underlying asset rather than their own intrinsic worth, they have no intrinsic value of their own. The value of an Ethereum derivative depends on and is derived from Ethereum's value. The underlying asset is neither held nor owned by the parties involved in derivative trades. Futures, options, and perpetual contracts are the most popular types of crypto derivatives. Now, let's discuss the futures of crypto. To trade futures, two parties must come to an agreement on the sale of an asset at a future point. The exact date and amount are also agreed upon in advance. The specifics of a contract can differ, but the basic terms are almost always the same. Institutional investors frequently employ futures as a sort of crypto derivative. Futures data is commonly used to forecast market sentiment and price fluctuations. Depending on how the market price changes in the future, traders may profit or lose. So if Bitcoin is trading at $40,000 and the expectation is that the price will rise or fall, an investor could purchase or sell futures contracts. The purchaser will have made $20,000 if the price of a futures contract worth one Bitcoin $40,000 increases to $60,000 before the contract expires. However, the buyer will lose $10,000 if the price lowers to $30,000 by contract's conclusion. Furthermore, Bitcoin futures are contracts between two parties to buy and sell Bitcoin at a predetermined price on an agreed-upon date in the past. Any other currency specified by both parties may also be used to conclude the contract. What is the best way to trade Bitcoin futures? When trading Bitcoin futures, the contract's duration is the first thing a trader has to know. Weekly, bi-weekly, and quarterly options are common on crypto derivatives exchanges. For instance, if you trade Bitcoin contracts once a week and each contract is worth $1 of Bitcoin and costs $10,000, it would take 10,000 contracts to open a position worth 1 Bitcoin. A trader has two options when it comes to Bitcoin's price. Either go long, buy Bitcoin, or go short, sell Bitcoin, going short. As a result, an exchange platform will pair the trader with someone who is bet against them. When the contracts are settled, one trader will have to pay up, depending on whether the Bitcoin price has risen or fallen. Now let's discuss crypto options. An option is a sort of derivative contract that allows a trader to purchase or sell a specified commodity at a fixed price at a future date. Options, on the other hand, give the buyer the option of not purchasing the asset if they so desire. Call and put options, as well as American and European options, are all types of options. If you want to buy an item on a specific day, you can use call options. If you want to sell an asset on that date, you can use put options. American options can also be sold before the expiration date of the contract, whereas European options must be sold on the exact date set forth in the contract. Purchasing a contract from a broker necessitates the payment of a fee. If an option costs $800 to enter, a trader must pay the amount on top of the asset's real purchase price. The $800 charge must be paid by the trader regardless of the outcome of the trade. As a result, it's important to remember that trading crypto derivatives with options does not come without risk. Let's take a closer look at this. Let's say you want to buy a call option on $50,000 worth of Bitcoin. However, the price was reduced to $40,000 on the agreed date. In an option, the $10,000 loss would not be on your shoulders. Instead of fulfilling the contract, you can simply exercise your right to not do so. But you will not get back the $800 price you paid to buy the agreement. As a result, your total loss would be $800 in this scenario. Options trading with Bitcoin. What are the steps involved? Call and put to Bitcoin are analogous to going long and going short in futures trading. You have the opportunity to buy Bitcoin at an agreed upon price when the contract expires. It is possible to sell Bitcoin at a predetermined price via put option. For example, let's say a trader buys a call option for Bitcoin at $20,000 for a 1-month contract. If the price of Bitcoin goes up to $25,000 by the end of the month, the trader will likely use their right to buy it and make money. On the other hand, if the price drops to $15,000 by the end of the month, the trader will probably choose to let the option expire so that he doesn't lose anything except the premium he agreed to pay when he bought the contract. Exactly what are perpetual contracts, and why are they so important? A perpetual contract, also known as a perpetual futures contract or a perpetual swap, is the most common type of crypto derivative, especially among day traders. In traditional finance, a contract for difference or CFD would be the equal of a perpetual contract. Perpetual contracts have no expiration date, unlike futures and options. Holding positions for an extended period of time is possible for traders who pay a fee known as the funding rate in exchange for the privilege of keeping their positions. There must also be a certain amount of money in the account, known as the margin. Because underlying assets frequently experience price fluctuations, there is sometimes a significant gap between the index price and the cost of perpetual futures contracts. Those who choose to go long would typically pay the funding rate to make up the price difference if, for instance, the perpetual contract's price is higher than the index. People who choose to go short would also be charged a funding rate if futures contract prices were lower than their index price. What should you do if you're trading a perpetual contract? The price of perpetual contracts, rising progressively above the spot price, would have little incentive for traders to open short positions if many of them had long holdings. In the end, we have a higher financing rate because of this. All long positions must pay all short positions when the funding rate is positive. An alternative scenario is one in which the rate of funding is negative, in which case any short position must cover any long position. For the price of the asset, say Bitcoin, to be returned to its true market value, traders can be rewarded for closing long positions and opening short positions under this arrangement. There are no exchanges involved in the payment process, and payments are made straight to traders. What is the significance of crypto derivatives? Derivatives are vital to the crypto economy since their activities extend well beyond the investment portfolio of a single individual trader. As with any well-established financial system, derivatives play an important role in helping the cryptocurrency market establish itself as a legitimate asset class. What can we do to improve liquidity? To begin with, what exactly is liquidity? In a nutshell, it relates to the ease with which orders may be placed on a market without altering the asset's price. It reveals the number of buyers and sellers and the ease with which transactions may be completed. There is a large supply and demand for assets in the liquid markets, which makes them more accessible for buyers and sellers. An illiquid market, on the other hand, is characterized by a small number of participants and a small number of transactions. The simplicity with which traders can open or terminate positions is facilitated by the use of crypto derivatives. Due to the fact that there is always someone prepared to take the opposing side of a trade, there is often less risk in an open market. As an illustration, consider the case of perpetual contracts, in which shorts and longs are paid according to the funding rate. Investors and dealers flock to a market with a high degree of liquidity. Transaction costs are lower, slippage is reduced, and the overall market environment is more favorable. What about mitigating risks? In light of the extreme price volatility of crypto assets, derivatives might help shield a portfolio from unanticipated losses. Cryptocurrencies' strong derivatives market helps to attract experienced traders and institutional investors, since it mitigates the danger of exposure to tail risk occurrences. In uncertain market conditions, where options prices tend to be overbought, derivatives can also indicate risk. Risk-averse sentiments will prompt traders to buy options as a precautionary measure to safeguard their investments. Let's talk about portfolio diversification now. Traders' investment portfolios might be more diverse thanks to derivatives. They have the ability to work with a wide range of cryptocurrencies and to grasp complex trading tactics. Arbitrage, short selling, and the like are examples of more advanced trading tactics. Because of this, smart trading tactics improve the value of the underlying crypto asset. How about optimized price discovery? The primary purpose of a marketplace is to continually discover the current price of a specific asset. Liquidity, market structure, and flow of information all have a role in pricing. In order to improve price discovery, crypto derivatives allow investors to either go long or short. As a result, processes for determining prices become more effective as market fluctuations are smoothed out. As a result, there are no negative price shocks. A more efficient market is created as a result of greater price reliability as a result of better price discovery. In addition, participants are sure that the asset's price reflects all relevant information. So, how exactly do crypto derivatives work? First of all, derivatives are used for either hedging or speculation. Let's get over hedging. Protecting a cryptocurrency holding with derivatives is possible. Hedging is the term for this. Hedging is the practice of taking positions that have an opposite or negative correlation to your current investments. Investors and traders use it to safeguard their portfolio and reduce the impact of losses. Futures, for example, can be used to safeguard investments without affecting existing crypto holdings. Because futures allow you to hedge a portfolio for a fraction of the cost, this is the reason why this strategy is so popular. Open a short position in a futures contract for $100,000, for example, to protect your investment account. Investing $10,000 in a 10x contract will cost you just 1/10 of your portfolio's market value, or $10,000. Bitcoin's bear market provides an excellent opportunity for hedging, as it's better than either waiting for the price to recover or selling at a low price. Here we go with speculation. Speculating on the future value of cryptocurrencies is also possible through the use of derivatives. If the price of Bitcoin rises, for example, you can make money. Because prices are always going down in a bear market, you can't profit from this theory. Futures contracts can help here. As a result, you can make a wager that prices will fall, going short. Even in a bear market, if Bitcoin's price falls, your short position will result in a profit. To trade, take advantage of market volatility and capitalize on chances by going long or short. Futures contracts are the best option available. With leverage, you can buy a lot more of the underlying asset for much less money, which is another reason why derivatives are appealing. In the case of Binance, for example, users can choose leverage of up to 125 times the starting margin. As a result, even modest price increases might provide substantial returns on your investment. Investors might profit greatly from modest price swings thanks to leverage. What are the features of derivative trading exchanges? Some of the features of crypto derivative trading exchanges may be of interest. First is stop loss and take profit. It is possible for traders to set a stop loss and a take profit, allowing them to control the price of their trades. As a result, if the market conditions are favorable, they can immediately quit the market based on the pricing they specified. Secondly, partial close orders. Partial close orders allow traders to take some profits while closing their positions. As a result, the market's development will continue to benefit them. Thirdly, there's auto-deleveraging, or ADL. The ADL system can deleverage an opposing position from a designated trader if a position cannot be liquidated at a better price than the bankruptcy price. If your insurance policy doesn't cover the full cost of a contract loss, this can be especially useful. Finally, insurance funds. It's important to note that insurance funds can assist protect traders' cash from ADL if their holdings fall below the required margin. When it comes to derivatives, what are the benefits? There are a few advantages of employing crypto derivatives. Market efficiency. Due to the arbitrage nature of derivative trading, it aids in maintaining accurate market pricing for underlying assets and a stable market. Low transaction costs. Market transaction costs can be reduced by the use of derivative contracts. As a result, the transaction costs of derivative trading are lower than those of securities such as spot trade. Risk management. Underlying assets determine the value of derivative contracts. As a result, derivatives are employed to reduce the volatility of these underlying assets. Suppose a trader acquires a derivative contract and the underlying asset's price declines. He can offset the losses with gains from his derivatives. As an illustration, what factors go into calculating the underlying asset's price? Derivative contracts are an important aspect of the cryptocurrency economy since they are used to set the values of underlying assets. First, high leverage. Leverage can be used to boost profit margins without the requirement for a substantial initial investment. Next is high liquidity. Because of the strong demand for derivatives trading, the markets are extremely liquid. In 2020, the daily volume of crypto derivatives is expected to exceed $600 billion, according to a study. To maintain the markets lively and liquid, derivatives have continued to draw institutional investors and traders alike. There is also diversification. The values of underlying assets are taken into account by derivatives, which helps investors minimize portfolio risk. As a result of market activity, investors and traders alike benefit from the generation of market movement signals. Now let's talk about the disadvantages of using derivatives. Crypto derivatives have a number of downsides. There is a bigger risk. These contracts can be extremely volatile because the underlying asset's value is constantly changing. As a result, traders are at danger of losing money, particularly in leveraged contracts. One of the disadvantages is that there are regulatory concerns. Derivatives trading is still banned in several parts of the world. There must be an area where derivatives trading is allowed for two parties to enter into futures contracts. Another issue is a lack of due diligence. Due to a lack of due diligence, there is a counterparty risk when trading over-the-counter futures contracts. Over-the-counter transactions do not always adhere to tight regulations, making it impossible for the trader to conduct a thorough background check on the other party. What are the best ways to trade cryptocurrency derivatives? When trading crypto derivatives, there is no one-size-fits-all strategy to ensure that losses are avoided. In order to protect your money and make an informed investment decision, you can follow a few simple guidelines. In order to determine which derivative is suitable for you, you must consider the current price fluctuation pattern. Using an options contract is a good strategy if the market is expected to rise in the near future. Investing in futures contracts is a better option if the market is bearish. As a result, if you are unclear or the market is behaving in an inconsistent manner, you can opt for a perpetual futures contract. In addition, you should avoid betting more than you can afford to lose while hedging your portfolio. Using borrowed assets and reselling them to a new buyer is a common strategy among seasoned traders. That way, they can get the assets at a much reduced price if the price drops in the future. The trader might return borrowed assets and pocket the earnings. Traders must pay the difference if prices rise. Always make sure you can afford whatever damages your actions cause. Choose a reliable crypto derivative trading platform. Choose one with verified users, significant trading volumes, and fraud detection procedures. Crypto derivatives trading is good for beginners and pros. Depending on your risk tolerance, you have several possibilities. If you enjoy this video, please support us by clicking like and subscribe buttons so you won't miss a video.